Hello, Dale. How are you?
Great to meet you, Nicholas. This is our first time,
This is
correct?
our first time indeed.
Our
Yeah.
first date? Okay. Really great to have you here. I reached out to you on Twitter and I've been to your website. Are you here to share anything or do you want me to do it while you and I are talking?
Well,
Share your
I
screen.
was listening to your conversation earlier, but should I give you a bit of background on me? Would that
Yeah,
help?
I was gonna start there. I wasn't sure if you were gonna share your screen for anything yet, but
Not yet.
oh, okay. Well then, just so
Well,
there's
I
something.
could.
Okay.
um, Share screen. Let's.
Okay, now I have to stop share. Okay, go ahead.
Okay. So share screen. Let's do the screen that everybody should watch, which would be, I believe, is that one. Yeah. Can you see that?
It's trying to there. Okay, we've got it. Okay,
You
so
got it.
you're, all that looks like you're following, a lot of yield charts. So why don't you
Yeah,
tell us a
I'm
little?
well because I think it's the driver. But
Yeah.
let's start on me if that's
Okay.
the
So
way we should.
tell me what were you doing and what was your first gig in the business?
Okay, first gig in the business was actually Merrill Lynch. Started
Okay.
in London, then ended up for a while in Australia, Hong Kong, and then went back to London. It was where I was involved in the end at Merrill Lynch, helping to set up the European government bond
Okay.
trading and research efforts. And then,
You weren't cold calling for Merrill. Hello, Mr.
no,
Gruber.
no,
Huh? Okay.
more on the institutional side. And then left Merrill
You were
Lynch.
spared.
I was spared that, yes.
Yes.
Left Merrill Lynch uh, to go to Salomon Brothers, where I spent a very happy
Oh,
10 years.
yeah.
Ended up running futures and options. And subsequent to that, set up a hedge fund, which was um, part quant, part macro. So it was quant with a macro overlay for risk management purposes. And then what we did, I took a little sabbatical as I got pulled into an effort that was doing wireless data for market information. And we did Telerate. We developed Telerate on BlackBerry. We developed some of the Reuters efforts on BlackBerry as well. And then went back to the market, um, joining some of my old Salomon colleagues who'd gone via um, Credit Suisse to set up Brevin Howard. So I wasn't there setting it up, but I joined Brevin Howard subsequently. And um, with the exception of a couple of, shall we say, repos to other firms, did a couple of stints at Brevin Howard. And I have to say, really enjoyed myself. I mean, it was like it was like running money in a university, but
Nice.
surrounded by,
No heat, huh?
well, there's always heat, but it was, I've got nothing but the highest regard for my old colleagues that set it up. I mean, Alan and Trifon and also the other founding partners. And too much travel came along and have spent time here between Brazil and Miami. I spent time at a large Brazil hedge fund consulting, and now we've set up this intelligence quarterly effort.
Yeah, it's
Um,
really a nice, very nice website. I'm showing it for you.
Thank you. So what
And
we do, that's my column there is the ahead of the herd, which is
okay.
global macro, and then we've just attached to it, which we've been doing for a while.
Wasn't that an old Wall Street Journal column?
That
Something
was heard on the street.
okay, I thought there was something with the herd, but
I
okay.
I think it's heard on the street. Anyway,
Oh, that's right. You're right.
yeah,
Heard on the
yeah.
street. Yeah.
So attached to mine is not now a subscription, but it's actually, there's a lot more behind it. So we do quite a lot of consulting for hedge funds, mutual funds, some C-suites, a couple of sovereign wealth funds, and we have a shadow business that actually also runs money. So one of my partners, Tracy Schuchart, she runs a family office exposure to energy, basically oil and gas. And we've got quite a few guest contributors, one of whom is Patrick Perrett-Green, who's really a top quality rates specialist, whom I got to know when I was at Brevin.
Joseph Wang was on here last
Joseph
week.
Wang was on here. That's right. I like Joseph enormously because sometimes, for example, Zoltan Pozar's got a lot of publicity lately. I can't say I agree with very much with what he says. And I just like to have someone that's been at the front line within the organization, within the Fed, because that's where you're going to hear the plumbing. How does the plumbing work? How does the plumbing affect global markets? So on and so forth. And I think that gets lost in a lot of, shall we say, the meme conversations that you would see on Twitter. So I'm much more interested in what really happens. I mean, there's no doubt we upset people occasionally, but
okay.
we just
let's try that now.
Yeah. No.
What are you looking for from the Fed today? And is most of this, whatever they're going to say, priced in, or they have the S&P right on the cliff at 4,100? If we take out that low, to me, that we put in Monday, there's a lot of space underneath the market.
Oh, yeah. Well, my thought process on the Fed has been the same. Well, it's been the same since GFC. I don't trust them. Okay. I think they're prone to policy errors. I think the ECB is prone to way more policy errors. The Bank of England is trying to get away from policy errors, and not quite sure what error the Bank of Japan's committed, but they've definitely committed some. But the thing is, so when I look at the ECB, for example, the Fed, for example, right now, I'm very much a traditionalist when it comes to central bank and monetary policy. So I'm always quoting Bagehot. And I'm thinking that, we're going to find out. I listened to your earlier conversations with your colleagues, and this idea of a U-turn on the Fed on first signs of economic weakness. I suspect that's probably right. Now, I don't know whether it's a U-turn or a stop
or a pause. How about the word pause?
Exactly. So my thought process on the Fed is, and this is where I disagree with one of your colleagues on the non-farm payroll and unemployment data. For the last year, I've not been watching non-farm payroll. We knew what was going to happen. We knew it was information that was extremely distorted. Yeah. But I'm watching the wages, and I'm watching the unemployment rate. The Fed watches the unemployment rate. And we're in a situation now where we have high inflation, increasing wages, increasing
labor shortage.
And a labor shortage, increasing trade unionization. And I think that's key. Okay. Because for stagflation, you need wage inflation, right? Uh-huh. And so I'm watching that, because my thought process in terms of the market, and that's why I put the Treasury market page up on Bloomberg, is I actually think yield curve steepening. I've got a 20% position in yield curve steepening. I'm not fully exposed yet.
The Great Steepening.
It will happen. It's inevitable. It's going to happen. And I tell you why. Either we go into, they don't manufacture a soft landing, which is going to be really tough given extraneous factors as well. But just within the US economy, I think it's, they're praying that they can. And I don't think praying is a good policy decision. So if we don't get a soft landing, we actually move into recession with inflation. But all recessions, you see the yield curve steepen. Okay. It's a historical fact. Now, what if this Fed decides pause or stop and reverse? That means they're giving up the fight against inflation, which is getting stickier and stickier. And I'll get back to that in a second. If they're giving up the fight against inflation, then the yield curve, the long end of the yield curve, should see higher rates, definitively against the short end, yield curve steepening.
Right.
And then, you know, in our work with Joseph, the assessment, and I think he's absolutely right, of QT will also lead to yield curve steepening, coupons to go. So to me, yield curve steepening is inevitable, and it's all a matter of timing. Now, I actually did this at the beginning of April, put 20% on, was really tempted to put some more on, and it's still in the money. And I just think that's the trade. It's hard. My view is that the long end will go north of 3%. I just am convinced that this Fed, central banking seems to have changed. People are not willing to accept the idea of 2 quarters negative growth to slow down inflation. People have forgotten how destructive inflation is to the economy and people participating in the economy, particularly lower and middle class. And if you want an extreme, just go to Europe. I know for a fact on the ground, this will be a very unpopular statement to make, but on the fact, on the ground, if you go to somewhere like Portugal or Spain, they're all wondering why they're going to be banning Russian oil and gas because of Ukraine. Their view is, and this is just people in the street, and I've got friends who work in the business in both countries. The people's view on the street is, why are we paying much higher energy and food costs because of the Ukraine? What does Ukraine mean to us? So I think that's a display of inflation is destructive. It is a regressive tax on everybody, but particularly on the lower and middle income families. And it's the same in the US. I was already an inflationista before the war started because obviously supply chains were severely disruptive. And by the way, I think what's going on in China right now with the lockdowns, why are people saying we may have peaked in inflation, but we ain't going down? The supply chains are being this, if you look at the ships outside of the Chinese ports, it's enormous. Well, that will feed through eventually. And you've now got the semiconductor industry, where back in 2020, everybody was saying, well, it'll be, supplies will be normalized by 2021. The latest forecast is not before 2024. You've got Maersk warning about stagflation and also the supply chain situation in China. So I'm not sure. I think some of these, yes, we've got great comparables, but I think some of the underlying inflation problems will just continue. And people forget that the boost in energy prices, that has a lag of 6 months before it starts to feed through to the consumer level.
Okay.
In terms
and Fed policy too, Nick?
Yeah. So I just wonder, my fear is that the policy mistake I worry about is the Fed is not prepared to be tough enough and let the economy have a recessionary dip to quell the inflation. You've got to have demand destruction. And then if we're worried about stagflation, the big variable in stagflation will be wages. And if we're seeing increased unionization in the US, well, that's not a positive. That's not a positive for the wage inflationary outlook. That's a negative. These unions
you see this 20-year TLT chart.
Yeah.
People have been talking about it for years, and I think it was Luke Roman said that the one thing that people might be missing is that perhaps we're in a sovereign debt crisis. Do you think? This chart, you would think that there's going to be some type of decent rally, but it measures 90 on TLT. So, are we in a sovereign debt crisis here in the U.S. and globally? Because the Fed has really been the main buyer of treasuries.
No, I don't think so.
Okay.
Again, with regard to Luke, I disagree about the dollar. I think.
Okay. So you still think higher dollar, and this is part of the squeeze.
Well, potentially higher dollar, yes, particularly against the yen. If you pull up the dollar yen chart, you can see it, and you go back. I think I did a monthly chart, so you've got to go for a longer history. There's a reverse head and shoulders.
Okay, yeah, and this was the right shoulder.
Right.
Yeah, and it
Well, that
measures like 150 or something, doesn't it?
170 is a
Okay.
projection.
Yeah.
Okay.
So that's
Now,
sharply higher yields. Yeah.
yeah, exactly. And the thing about the dollar is, I've been on various. Actually, I was on the main Middle Eastern channel with instantaneous translation, which is always fun to see it afterwards. And it was an hour's program discussing the dollar as a reserve currency. And there was myself, and then there was a chap from Beirut who was very much of my view, and then there was a chap from Russia, that was very interesting. And you could see all the three faces on the panel because we were all virtual, and they kept coming back to me because my eyebrows would shoot off the forehead on certain things that the chap in Russia was saying. The point about the dollar as a reserve currency, who threatens the dollar as reserve currency? People say the renminbi. In the old days, they used to say the euro. You're talking about the two most mercantilist economies of the world. They love their surpluses. Then you look at China, they love their control. Neither bloc, I'll define them as blocks because that's relevant for euro, neither of which are prepared to accept Triffin's dilemma. You got to run a current account deficit. You got to have a free float. That's completely anathema to both the Chinese and the European Union, i.e. Germany.
So you think Israel has it wrong reducing dollar holdings?
No, of course you're going to have to. You see, my view is, I think actually, I'm very positive. I'll put this out there. Let me put this out there. I'm quite positive on an Anglospheric arrangement, and I would include the yen in that in terms of they're very Anglosphere adjacent. So, I've noticed that actually, interestingly, sterling has stayed steady. The Aussie dollar is of interest to reserve managers. The Canadian dollar is of interest to reserve managers. There's enough liquidity out there. When you talk about a sovereign debt crisis for the US, my point is, if you accept that the US dollar prevails in terms of liquidity, and remember, vis-a-vis the dollar, you have the euro-dollar market.
Yes.
There's nothing equivalent to the euro-dollar market from any of the other currencies.
Bigger, yeah, that's right.
Why did one of your colleagues talk about dollar shortage in Europe being problematic? It is, right? So, that's why you have the Fed swap lines. And people say, well, the US has weaponized the dollar. The dollar was always a weapon.
Yes.
1973.
Hegemony was enforced.
Exactly. The British
differently.
Exactly right. So there's a history of it being weaponized. It's always been a weapon. But the point is, people have got to put their money somewhere. And that somewhere has to be liquid. So I don't think there's a sovereign debt crisis involving the US. I think yields could go higher. And I do have a solution for all these Anglospheric central banks.
And a debt jubilee.
Exactly. And it would exclude the ECB, of course, because they can't do that. But if you think about debt jubilee, it's just canceling two sides of what is de facto the same balance sheet.
Right.
It's the same balance sheet, if you think about it. Now, what are the consequence that would worry me about a debt jubilee? Because that's the way I look at the debt situation. But the thing that worries me about the debt jubilee is if you had it, can you imagine what certain governments would do suddenly with look, our balance sheet has been cleaned up. We've got a lot of fiscal room. And that's where the inflation comes from as well. People are, looking for reasons as to why inflation is so high in the US and everywhere else. Fiscal. Yeah. I'm quite monetarist in that sense. My piece yesterday was the inner Milton Friedman in me. Fiscal has been problematic for inflation. There's two problems that occurred, I think, in the US. The Fed carried on adding liquidity until recently. They didn't need to. They should have stopped last year. And that last fiscal boost was just too big.
You and Larry Summers.
Yeah, amazingly, I agree with Larry. It's been a rare event, but I find myself agreeing with him more and more. So my concern with the Fed, I think I doubt whether today's meeting, unless there's real meat to the QT, quantitative tightening announcement,
right?
I doubt if today's meeting will be a hawkish surprise. And I think he will maybe not push back. If somebody's going to ask him about 75 basis point rate hike, with 60% market discounting that for the next meeting after this. But I doubt that. I think he will sort of say, well, that's not really on the table. We haven't discussed that yet. And that may be the thing that triggers a short covering rally. And, even if we get up to 4,300 or 4,500, bear markets have horrendous rallies if you're short. And I mean, I can certainly see a reason for the market having a rally, but there was one comment I wanted to make, and somebody mentioned ARK in your chat before.
Yes.
Okay. Yeah. ARK is your archetypal, excuse the pun, retail stock, isn't it? Retail ETF. It's retail. And if you look at the shares outstanding in ARK versus the price decline, retail hasn't sold. And I suspect that's the case. From what I'm hearing, that's the case across the markets.
Oh, they're still following her around and wanting to take selfies with her at Bitcoin conferences.
Exactly. So
you'll know they sold when they show up with pitchforks and cattle prods.
Yes, exactly.
Right, buddy? Then you'll know.
Dale, I so agree with you on that one. But I think it's a good indicator. It's something worth watching in terms of what's retail doing. And there's what we try and do in this site, and what we try and do in our consulting work is bring everything back within the cognitive threshold, because there's so much cognitive dissonance out there and nonsense. The fundamentals are not, if you do your work and your research, you can get to your fundamental positions, pull yourself back from all the noise out there. And noise has just increased exponentially, particularly with social media. And our aim is to say, look, particularly over this year, I mean, we got bearish NASDAQ right at the end of last year, and we started to get short NASDAQ and some of the tech stocks for the inflation, for the bond market, so on and so forth. And the rationale behind that was these rates can't go lower. These rates in the US have to go higher, right? Now where that feeds through over, for example, to Europe, and where there's differences there, is one, the ECB is not the lender of last resort. It's not a Baghotian central bank. They're caught between a rock and a hard place. The rock is inflation, and the Germans are going crazy, but so is actually on the ground now. I think a lot of Europe's going crazy. Watch the wage claim. I think IG Metals was 8.5% was the wage claim they've just put in. Even the ECB's staff union put in a wage claim for 5.5%. That told me something. They have these
10-year. I mean, if we rallied the 10-year back again one more time towards 3, you were talking about 3.25. To me, this is starting to not confirm new highs, and that's usually a sign of not to short them, but at least not be.
Well, that's why I'm talking
bullish
on the yield curve, because if it doesn't go higher, that means the short end's suddenly adjusted to a different expectation, like
back to 240 or so.
Yeah, I mean, that's possible. That's entirely possible. I don't think it's justified.
Yeah,
and I think I'm waiting for some of the wage pressure to start shaking.
So your highest conviction trade is plain the Great Steepening.
I just think I can't see how it doesn't. If you look at you've got quantitative tightening, but if you look at the two alternatives, we go into a recession. The Fed gets. I think the odds of a soft landing are much lower than the odds of creating a recession. How deep the recession will be, who knows? So if you go into a recession, historically, a recession always has yield curve steepening. Now,
Okay.
if the Fed stops, and particularly if they U-turn, you're going to have yield curve steepening again because they've given up the fight against inflation.
Yeah, I think it's going to take a lot more S&P damage for them to U-turn.
I agree with you. And actually, I think in terms of the S&P and the Fed, I said this at the beginning of the year. For the last 40 years, but particularly since the GFC, the Fed's job was suppressing volatility.
Yeah.
Which was good for the S&P, clearly, as was the liquidity injected. We're now in a situation because we're in a deflationary world. We're not in a deflationary world anymore. We're in an inflationary world where just-in-time inventory control no longer works. It's going to be just in case, and that, by implication, is higher inflation. But so if we assume we're now in an inflationary world, they can't suppress volatility. It's just impossible. They've got to
Great
revert.
news for VIX traders and FX traders.
Well, can I say something on the VIX? I've had this disagreement with somebody for a while. I think there's the VIX. We at Brevin Howard, we had a visit from the originators of the VIX ETF, and they said to us, I think I was one of a few people there. They said, do you trade the VIX? And I turned around and said, well, I used to until you did the ETF. So when I talk about market volatility, I'm actually looking at broad market volatility. If you look at the volatility, if you look at the MOVE index in bonds, remember bonds is the oil that feeds the engine. Okay, that is surged higher, and it's not coming down. You look at FX vol. Just look at dollar yen or dollar renminbi or euro yen vol, 1 year vol. These are really very extended on the high side. I have always looked at FX vol as a lead indicator for something breaking somewhere when it starts to spike.
Okay, well, so I mean, this was a monster move in yen, and it's turned into a pretty good monster move. A dollar rallied a lot further than I thought it would. And there's still people looking for higher. You're probably one of them, 107, 110.
Well, I originally, way back when we were around 92, we made a call for 104. So we haven't been far away.
Okay.
Yeah.
So we're there.
Yeah, well, I'm not.
Almost.
We're almost there. And my view on the Fed is the first reaction today will probably be the wrong reaction.
Yeah.
Much more.
Love that action.
Yeah. I just want to hear what he says. Yes. And then, he can say certain things. Then we've got a slew of Fed speakers coming out thereafter. We have to listen to what they're saying. We have to be convinced they're so behind the curve. That's where I agree with Mohammed El-Arian. They are so far behind the curve. There is a credibility issue. And if you look around the world where there's been credibility issues, Reserve Bank of Australia is a good example. And their bond market yield curve control got defeated by the markets. And yesterday they raised rates a quarter point.
Yeah.
Whereas it was 50-50, 15 basis points or nothing. Now we know that the central banks all speak once a month via the BIS. We've seen hawkish from Canada, hawkish from Australia, hawkish noises coming out of New Zealand. Bank of England would like to be more hawkish, but there are issues with the economy there right now, which obviously, because of what's going on with Ukraine and Europe, I think if that's an indicator of what the Fed's going to do, we should expect hawkish. But I find it difficult to think that.
And hawkish in terms, and let's wrap it with this, hawkish in terms of QT and the timing and amount. That's what we should
I think Powell, to be hawkish, I think Powell will not rule out anything in the presser vis-a-vis questions.
Okay.
That is where I have my doubts today. I think he may say we haven't discussed 75 basis points.
Well, I'm going to send a DM to Pedro da Costa and have him hammer Jay today until he gets an answer.
That
All
would
right.
be fantastic. Fantastic.
Nicholas, really a pleasure meeting you. And looks
Likewise.
like, guys, some excellent content here as I've been scrolling through Nick's
we have a
webpage.
weekly free on Sunday.
Oh, okay.
Which is
All
called
right.
The Week That Was the Week Ahead, where I
Okay.
just take highlights from everything and just give people a taste of what mattered to people, our subscribers, and also because the interesting thing is what we're trying to do is bring institutional thought process
To
risk
reach
management
to the the
that's what
little
the site's
people.
for. Yeah,
You're bringing like real high-end, highbrow research to
that's what we're trying to do
the
in a way
serfdom
that can be understood. You know, we can do the complex stuff with our consulting projects, right? But we want to make it understood because we're in a high risk environment right now.
Yeah.
And people have got to watch out for that banana skin that sits there around every street corner, ready to trip you up, slip you
Well,
up.
if they've been in this business, they're aware that the waters are filled with barracudas and sharks.
Exactly. That's exactly.
Right. So everyone be careful by the shore. Nicholas Glinsman, you could follow him also on Twitter at @Glinsman, and check out intelligencequarterly.com. Shy Girl does his commodity stuff, and
Exactly.
we'll do this again down the road.
I would
Nicholas.
love
What do you
to.
think?
I would love to. Absolutely. Okay. We'll get aggressive in terms of interaction. How's that, Dale?
Okay. Peace, and you're now my trading warrior brother. So most of my best friends in grade school, we fought on the playground first. So rite of passage for a little boy. So thank you, Nick. It was great meeting you.
Likewise, Dale, and have a good
luck
day.
today.
Good luck to everybody out there.
All right. Adios.
Okay. Adios.
All right. So everyone, that's a wrap. Good luck today on the Fed. Remember, don't try and predict it. React to it. And we'll see everyone tomorrow. And good luck the rest of the day. You're very welcome. And thanks again, Nicholas Glinsman, for edifying the community today. Adios, everyone. And join the team in now 10 minutes for the morning edge. See you later.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.